I'm concerned that a number of our states, for political reasons, are cutting themselves off from major financial institutions. They'll end up earning less money on their deposits and paying higher fees and costs when they issue bonds. I agree with Mr. Lukemeyer. We cannot see a return to the Operation Choke Point. And I'm concerned that bank regulators talk about reputational risk. Reputational risk should be factored in only when the bank is providing services to someone who's doing something illegal. But if we decide that there's a reputational risk to a bank for having a bank account for a customer that is very unpopular, then every time we have a Democratic administration, a gun manufacturer won't be able to get a checking account, and every time we have a Republican administration, Planned Parenthood won't be able to get a checking account. We don't want that kind of, with all due respect to the fine witnesses that are here, we don't want to give you that kind of political power, nor should we. If you want to make gun manufacturers illegal or Planned Parenthood illegal, the way to do it in democracy is pass a law in Congress, not prevent them from having a bank account. We have a policy in this committee that we mark up legislation only after we've had a hearing on that legislation. There are a number of bills that are listed as part of this hearing that really don't have much to do with the topic of the hearing, and that seems to be a possible loophole or a run around the rules of the committee. I do want to agree with Ms. Eberly's comments on Operation Choke Point. Do we, would it make sense for us to be concerned about a bank's prudential risk, Ms. Eberly, if they lent all their money to the Quebec Fire Insurance Company or to other similarly situated fire insurance companies as fire risks are going up?
Any kind of concentration risk that an institution has is something that an institution has to manage. We have longstanding instructions that are public on our website as part of our manual of examination policies.
If you're concentrated in something that is less risky, is that less of a risk than being concentrated in something that is increasingly risky?
It would be. You have to take into account the range of risks that could manifest from having a concentration in any kind of business line.
And we just went through a process by which banks ignored the fact that we had that interest rates could go up and probably would, it felt good to say interest rate, inflation is transitory and interest rates aren't going to go up, but there was a real possibility that they would. Thank God, our blindness on that was not fatal. We now have a climate risk. We shouldn't blind ourselves to the warming planet any more than we blinded ourselves to inflation and interests going up. Mr. Gibson or Dr. Gibson, do we expect that those things that are affected by rising temperatures will become more risky?
I think we're concerned that climate-related financial risks are an emerging risk that we don't know enough about, so we need to learn more in order to be able to answer questions like their relative
And I would point
importance.
out that we also ought to be looking at the China risk. There is a significant possibility of a rupture in that trading relationship, and many of the borrowers are very dependent on the China distribution chain. So this may be the only, this month at least seems to be the only topic of our committee. This is, I think, our 412th hearing that has something to do with ESG just this month. But I hope you're looking at other risks as well, including the China risk, and I yield back.